2026, a lot of investors think, I'm safe. I just own the index. But if you look under the hood, matching a big US equity index at the start of the year meant taking massive bet on tiny group of names. The 10 biggest stocks alone made up a huge chunk of the index. Together, they added up to well over 35% of the whole portfolio. In other words, for every $100 you thought you spread across hundreds of companies, more than $35 were really riding on just 7 names. So on paper, you look diversified. In reality, though, your return to your risk are dominated by small cluster of mega cap AI-linked growth stocks. That concentration is the first hidden portfolio killer. The second killer is recency bias. Building your portfolio based on whatever just worked last year. Think about 2025. Tech hardware. One name surges, another quietly does the grinding work in the background. Take a simple example here. Seagate and Western Digital. These two returned over 200% last year. What does recency bias do here? It tempts investors to pile into the winner, assuming last year's chart is a roadmap rather than a rear view mirror. The problem is that fundamentals, cycles, and even product cycles in these kind of businesses can flip very quickly. The stock that lagged in 2025 might be the one with better positioning for the next leg of demand, or one less crowded by hot money. Recency bias turns investors into momentum chasers at exactly the wrong point in the cycle, buying stretched names after the easy money has been made, and abandoning positions just when risk-reward may be improving. In 2026, with AI chips and anything data adjacent still dominating headlines, recency bias is especially dangerous. It is not just stock picking, it is the way people end up with portfolios that are 60-70% allocated to whatever did best in the last 12 to 18 months. Whether that's mega cap tech, AI, or a handful of story names. The third mistake, over or under using entire asset classes just because they were noisy in 2025. Commodities, private credit, and alternative all grabbed a lot of attention, sometimes for the right reasons, sometimes just because they were in every headline and pitch deck. What often happens? Well, some investors ignored them completely, staying 100% in US large cap growth because that's what works. Others swung to the opposite extreme, stuffing portfolios with commodities, private credit funds, or complex alternatives, without really understanding liquidity fees, or how they behave in stress, or many more aspects of these asset classes. The point here isn't that commodities, private credit, or alternatives are good or bad. They can be powerful tools, inflation hedges, income sources, or diversifiers. The mistake is using them reactively because of last year's narrative, rather than deliberately based on your actual risk profile, time horizon, and need for diversification. The final hidden killer is spending more time on macro headlines than on actual portfolio and risk limits. In 2025 and into 26, investors have been bombarded with stories about the Fed, inflation scare, war headlines, AI bubbles, and recession calls. The result is a kind of macro addiction. People know every twist in the Fed dots, every inflation print, and every geopolitical flare-up, but they can't clearly answer basic questions about their own portfolio. For example, what is my equity bond split? How concentrated am I in a handful of names or themes? Or how much could I realistically lose in a bad year? And is that acceptable? The hard truth is that your portfolio is not blown up by one Fed meeting. It is usually damaged slowly by concentration risk, style drift, and a lack of guardrails. Things you can control if you are actually paying attention to them. So if you want to avoid the hidden portfolio killers in 2026, start with this checklist. Don't confuse index ownership with real diversification. Don't chase last year's winners. Use asset classes with intention, not because of headlines. Spend more time on your actual allocation and risk limits than on the macro noise. That won't make you the most excited person at the cocktail party, but it is how you quietly end up with a portfolio that survives the next surprise, instead of becoming the story